As of the market close on Friday, January 9, 2026, SuperMicro Computer Inc., trading under the ticker symbol SMCI, finished the session at 42.68 per share, marking a 4.15% gain on the day. With markets closed for the weekend, that closing price has taken on outsized significance. On the surface, a 4% green day appears to confirm the view held by many retail investors that upside momentum is beginning to reassert itself after several months of sharp volatility. However, a closer examination of the underlying conditions tells a more nuanced story. Guys, 99% of people watching don't like or subscribe to the videos, so please take a second to hit that like button and subscribe. It really helps the channel grow. That advance occurred on lower than average trading volume, a detail that materially alters its interpretation. Low volume rallies typically signal short-term relief rather than a durable trend reversal. In this case, the price action reflects a widening gap between public expectations for a high-performance server leader and the reality of ongoing institutional selling pressure. The divergence between narrative and positioning is now as wide as it has been in several years. On one side is the belief that accelerating demand for artificial intelligence infrastructure guarantees future upside. On the other is a more disciplined assessment focused on margin compression, rising costs, and unresolved governance concerns. The prevailing consensus among retail investors is that SuperMicro's role as a primary partner to high-end chip manufacturers ensures long-term growth. From that perspective, it seems logical to assume that as global demand for computing power increases, the stock should ultimately recover its prior highs. What complicates that assumption is not the demand side of the equation, but the company's ability to translate that demand into sustainable profitability. While orders for liquid-cooled server racks are indeed reaching new levels, institutional investors are increasingly focused on the sharp rise in cost of goods sold and the implications for long-term margins. There is growing concern that growth is being purchased at the expense of balance sheet strength. This disconnect has created a familiar but uncomfortable dynamic. Retail investors continue to buy perceived dips based on confidence in the technology story, while large funds use incremental rallies to reduce exposure and rotate into more stable infrastructure names. The result has been a stock that behaves independently of the broader technology sector. Over the past 30 days, SMCI has experienced frequent daily swings of 5% to 7%, despite a relatively flat Nasdaq and an absence of major company-specific news. That type of volatility is often associated with elevated short interest and heavy algorithmic trading concentrated within narrow price ranges. Trading patterns reinforce that interpretation. Volume consistently spikes during the first hour of the session, followed by persistent selling pressure into the afternoon. This suggests early retail enthusiasm is being met by methodical institutional distribution later in the day. At the sector level, momentum has gradually shifted toward hardware companies with more transparent accounting practices and clearer guidance for the second half of 2026. At the same time, sticky interest rates have increased the cost of carrying the large inventories required to support AI server deployments, further pressuring margins and weighing on sentiment. The investor experience surrounding the stock has become defined by frustration and disbelief. On platforms such as X and Reddit, a vocal community argues that the stock is being unfairly targeted by short sellers and negative media coverage tied to financial reporting concerns. High short interest is often cited as evidence of a coordinated effort against the company. From an institutional standpoint, however, the reduction in exposure by several large hedge funds reflects a recalibration of risk rather than a conspiracy. The uncertainty surrounding long-term margins has shifted the risk-to-reward profile in ways that no longer justify aggressive positioning. This environment has fostered a pronounced psychological divide. Retail investors are frustrated that the share price has not responded to announcements of large server orders, while institutions remain focused on unresolved questions around corporate structure and financial clarity. Stripped of the stock's volatility, the underlying business remains notable. SuperMicro has spent years positioning itself as a leading provider of high-density, energy-efficient servers. Its building block architecture allows it to bring new technologies to market faster than traditional competitors such as Dell or Hewlett-Packard Enterprise. The company's emphasis on direct liquid cooling directly addresses one of the most pressing challenges facing modern data centers: heat generated by next-generation processing units. This technical advantage has historically been the company's strongest competitive defense. Earlier reports showed triple-digit growth rates, which fueled the stock's prior run-up and reinforced the perception that SuperMicro is more than a simple intermediary. It is an engineering-focused organization with deep expertise in the thermal and power requirements of modern data centers. That distinction remains intact, even as confidence in the equity has weakened. Market psychology, however, has shifted decisively toward caution. Last month's panic selling, triggered by rumors of another audit delay, marked a turning point. That sell-off was followed by a surge of confidence from investors who believed $50 represented a definitive bottom. As the stock now trades in the low 40s, that confidence has given way to anxiety. Expectations of a rapid recovery towards $60 have collided with the reality of a prolonged period of uncertainty, where legal, financial, and governance issues exert more influence over daily price action than underlying demand for servers. At present, short sellers largely control the narrative. Until the company delivers a clean and undisputed set of financials, fear, uncertainty, and doubt are likely to remain dominant drivers of price movement. Institutional positioning further underscores this dynamic. Passive index funds continue to hold the stock by mandate, providing a degree of structural support. Active hedge funds, by contrast, have been rotating out in search of opportunities with lower regulatory and governance risk. This distinction matters because as active capital exits, the stock becomes increasingly vulnerable to retail-driven volatility and aggressive short positioning. The resulting price behavior is characteristic of a distribution phase, where positive developments are met with immediate selling. It has become a battle of attrition between retail investors attempting to outlast short sellers and those betting that another negative headline will produce a final capitulation. The company's forward outlook ultimately hinges on two factors: the sustained leadership of its liquid cooling technology and the restoration of trust with the investment community. There are identifiable catalysts that could alter the trajectory. A major partnership with a sovereign cloud provider or a meaningful improvement in gross margins in an upcoming quarterly report could rapidly shift sentiment. Similarly, actions such as a share buyback or a change in board leadership that addresses institutional concerns could increase the risk of a short squeeze. At the same time, downside risks remain substantial. Intensifying competition from larger, better capitalized firms would further pressure valuation, and any geopolitical disruption to high-end component supply chains would disproportionately impact a company operating with a lean inventory model. In this context, the stock's behavior reflects a complex interplay between strong technological positioning and unresolved financial and governance questions. Until those issues are addressed with clarity, volatility is likely to remain elevated, and expectations